Hello and welcome to the Monday Futures Market Outlook for May 28th, 2013. This is Patrick Sresna. As always, we start off a chart of the US dollar index futures, and over the last year we have remained relatively bullish the US dollar, anticipating a substantial strengthening in the index, and this continues to remain in trend. We're now continuously testing the 84, 50, 85 kind of overhead resistance, but if we have any legitimate euro breakdown, there's room for the US dollar index to break out substantially and even target 86, 87 on the upside. So we remain cautiously optimistic that the US dollar remain in trend. Next year, we'll take a look at the euro futures, and the euro continues to weaken off of its April and May highs around the 132, 133 area. If we see any legitimate breakdown in the euro below these levels, we can certainly see a move head down to 2012 lows, and that would be a very significant technical event, and certainly would be the catalyst that would drive the US dollar to substantially higher levels. We're really at the edge of the cliff here, and we'll find out whether the euro can or cannot make that break. We certainly have not seen a break yet, so we don't want to jump to any conclusions, but certainly it's not something to be ignored if that breakdown does occur. Next year, I want to take a look at the 30-year Treasury bond, and we were a little too ambitious in anticipating it just to be a retracement off of that high, looking for just a natural pullback, as now Treasury bonds have made a full retracement of the entire rally. At this stage, we find ourselves having consolidated around along the lows of the year around this 141 area on the downside, and this is going to be an area of major support. While we certainly were not anticipating there to be such a strong Treasury bond pullback at this juncture, it certainly has happened, but it doesn't change our scenario from a risk-reward perspective, as now this support is quite significant. Now, if we saw any real technical breakdown to lower lows, that would have to put us on the drawing board to rethink this whole trade. But really, as we find these supports down here, it is quite possible that the lows will be banged out down along this level, and there's room for the 30 years to retrace back, at least back up to the midpoints of the previous selling. Next year, we're going to take a look at copper futures. Copper remains relatively weak in our eyes. Well, we were suggesting that we could see short-term rallies as high into that, even as high as 350 on the upside. We continue to believe that this rally is simply just a bounce from an oversold state. As soon as copper finishes this consolidation, particularly if driven by a strong U.S. dollar, we could see copper weaken back down to its lows or lower. Next year, we're going to take a look at crude oil futures. Crude oil surprisingly remains near its year highs, up to $95, with the highs coming in, at least for this year, in the $98, $99 range on the upside. We do believe that the upside is limited if our currency outlook is proven correct. And that while it certainly appears that crude oil is not negative, it certainly is hard-pressed to suggest that there's a really bullish scenario here for crude. At this stage, you almost want to think of crude at the top end of a sideways range-bound market, and then every dollar rallies is coming to the top end of the support resistance bands and is likely to fade back down to the low end of the range. Next year, we're going to take a look at gold futures. Gold continues to consolidate near its multi-year lows around this 1350 support. This is a make it or break it moment for gold. Either it musters up a double bottom along this downside, but if it or if it's going to break, and if we see a downside break, there's a move that could go even as low as 1200 on the downside of gold. Now, we don't actually give it a very high probability of 1200, as the first move down was so significant in size that anticipating a similar magnitude move is sometimes, while possible, not probable. And so therefore, even if a breakdown occurred, maybe 1300 or 1250 are more realistic downside targets of a breakdown move. We actually believe at some point this year gold will be an epic buying opportunity, but clearly at this moment the trend remains down, and there's not enough evidence to suggest that this is where the buying opportunity has emerged. Finally, when we take a look at the S&P 500, we now have had basically the single longest rally without a 3-day market pullback. We've had only modest percentage pullbacks. This is now 356 S&P points from bottom to top, from the November bottom to the current top of the market, which makes it the second longest point rally that we have seen. And we've now surpassed the 6-month mark for its total duration. All these characteristics are very big warning signs for this market. And while we've had warning signs for you guys back in February and back in April, and each time the market defyingly advanced higher, it's hard to want to cry wolf again at this level. But every time the market rallies higher, it becomes even a worse and worse risk-reward proposition in there. And so you have to assess things for your own self at these stages in the marketplace. But really, at this point, we consider ourselves to be completely out of the market until there's a proper 6-week market correction that redevelops a proper and resets the risk-reward proposition for us to accumulate the market into pullbacks. So just to review our key intermarket observations, the U.S. dollar trend is our main good one. The U.S. bonds are sort of the kind of midpoint area. We are good on the risk-reward proposition, but we are very carefully here at a stage where a major decision will be made on those bonds, which may force us to have to reevaluate our assessment of the risk-reward proposition there. Just go back to that commodities. The risk-reward is average, which is not that bad, but the long-term trend is down, and there's no evidence of that trend being immediately reversed, and so we're just going to assess the situation as we move forward, but nothing attractive there. Now, U.S. stocks and global stocks are either been range bound or in a very distinct uptrend, and which has certainly been gaining momentum on the upside, but that doesn't make the risk reward a good for the marketplace. We view it that every time the market goes higher, it makes the downside risk larger and larger, and the upside potential less and less, and therefore the risk reward proposition is a continuously diminishing thing, especially as more time passes. And at this stage, we will not reset that risk reward until we have a traditional market correction, which will inevitably at some point occur. And at that stage, we'll reevaluate the market as a new buying opportunity. That was your Monday Futures Market Outlook. Thank you for joining me.